The Intelligent Investor is one of those rare finance books that instead of being kept on the shelves of wannabe investing bros has found its way onto the shelves of the likes of Warren Buffett, Charlie Munger, and Peter Lynch. And the reason behind that is simple. The principles that Benjamin Graham described in his book nearly 75 years ago are not random motivational ones that are so common these days. Instead, the book provides real, practical advice on how one can use a few technical principles to use the stock market to their advantage. And that is what we'll be focusing on today. A comprehensive, real-world, step-by-step guide on how to use the intelligent investing principles of Benjamin Graham's legendary book to join the ranks of Warren Buffett and other successful investors. And I hope you'll stick around till the end because we have gone as far as to derive a few easy formulae that when applied could make the difference between you remaining an amateur investor or you becoming a millionaire. So without further ado, let's jump right in. Stage 1. Building a list of stocks and equities. Now, अगर आप में से किसी ने कभी भी कोई investing video देखी है, तो you'll know that any investor worth his metal will tell you to first learn about investing before you jump into the world. But the fact that you're watching this video means that you're already halfway through that. So instead, I'll focus on the things that most investing gurus actually skip, which is how to start learning about individual stocks. Because you see, even if you've learned everything there is to know about the stock market, until or unless you have access to the right data, you won't be able to apply that knowledge. This is why the intelligent investor will always start his investing journey by compiling a list of stocks that he can then practice his knowledge on. And in today's digital world, that couldn't be easier. Websites like the fintech giant Guru Focus or Money Control are great for passing through long, exhaustive lists to narrow down a handful of suitable stocks. Hell, even standard news and magazines like the Economic Times or your favorite blogs are a great place to start. But remember, we are not doing this to figure out which stocks to invest in. Instead, we are selecting stocks on which we'll apply intelligent principles to figure out if they're useful or not. But that is something that anyone can do, right? So what makes it intelligent? Well, to do that, we'll have to find a way to make this process easier, more efficient, and more importantly, a way to ensure that the process is successful and foolproof. And for that, we turn to the next step on the list. But before we move on to that, if you've liked the video so far, I think you'll also enjoy the rest of our content. And if you're interested in things like that, please consider liking the video and subscribing so we can deliver it right to your inbox. With that being said, let's get back to the video. Step 2. Using Graham's and other criteria. By far, the biggest difference between an intelligent investor and everyone else is not that they have more experience, better tools, or even more training. Instead, it is the fact that they approach investing from a technical point of view instead of doing it basically like gambling. And as a result, the result that they see is far more consistent even when they're not seeing massive profits. And the best way to implement that way of thinking is the use of technical criteria to look through stocks. Of course, things like the market climate, current events, and the situation of the industry will play a huge part in the selection of what you want to do. But the selection of individual stocks should be done only when you're absolutely sure that they're going to be profitable. And for Benjamin Graham, that profitability comes from a stock being undervalued now but guaranteed to climb in the future. And to see if that's the case, he recommends you take a look at a few things. One of them is the company's debt to current asset ratio. According to Graham, only invest in companies with a ratio of less than 1:10. Similarly, a company's S&P rating, although misunderstood most of the time, can be useful. For the most part, you must avoid any stocks below B+. And then there are things like a current ratio of 1.5, a price to earnings or PE ratio of 9 or less, or a price to book value ratio of less than 1.2. All of these on their own might not be useful in selecting stocks, but a stock that fits all of these criteria is almost guaranteed to show you some level of success. Even simpler criteria, like if the company is giving out dividends, can give you an idea of whether it's viable to invest in. And just like that, by using a few neat little tricks, you'll have narrowed down your list of dozens of stocks to a handful of guaranteed successful ones. But we won't stop there, because being an intelligent investor is not just about avoiding bad stocks, it's about finding the absolute best ones. And that's where the next step comes in. Step 3. Determine the company's worth. This is the part of the process where your own personal intelligence and training will come into play. Because now, instead of looking at sharp, neat criteria, you'll look at things like a company's management, its business model, its market perception, and a whole lot of other things. But there are still some tips that you can learn from the intelligent investors of the world. Learning how to read financial statements, researching a company's minor managerial announcements, and even just making sure that the valuation has increased consistently for the past 5 years, which is one of Graham's favorite criteria, will show you which company has the highest possibility of giving you amazing returns. और क्योंकि आप पहले ही major risks eliminate कर चुके हैं, अगर इस जगह आपसे थोड़ी बहुत miscalculation हो भी जाए, तो it won't matter that much in the grand scheme of things. And if you've been following this guide closely, by this stage, you will have a list of 4 to 8 good stocks that you're confident in, with a couple of standouts that you think have a ton of potential. But even now, instead of just straight up buying these stocks in massive quantities like most people would, even now, the intelligent investor will take the smarter route, and that being step 4, determining the intrinsic value and optimum price. You see, while you may still make a profit, if you just go and buy a stock blindly, the difference between making a profit and making a fortune will depend on if you actually pay the correct price. And not only that, but occasionally, even when the stock is viable, at that point in time, it may be too overvalued, causing you to lose money even when everything else was perfect. This is why the most crucial task for an intelligent investor is to determine the actual value of the company and use that to decide how much they want to pay for that. And while things like learning the company's practices and the industry climate will help in this regard, some technical tools must also be used for a foolproof valuation. And luckily for you, the writer of The Intelligent Investor, Benjamin Graham himself, has derived a formula for finding that intrinsic value. Known as Graham's formula, the equation you're seeing on your screen right now, that is, intrinsic value is equal to EPS multiplied by 8.5 added to twice the growth rate, uses the company's average EPS value and its current and projected growth rate to find a very close approximation of the company's real worth. And once you know that, you can very easily see if the offered stock price is overvalued or if it's a steal. But you're still not done, because the last step for you will be to decide how much you're willing to pay. You see, big investors like Buffett and Lynch don't just pay for stocks that are at the right price. Instead, they set a price for each stock above which they won't buy it. Meaning if, for example, a Coca-Cola share is worth $60 intrinsically and the company's offering it at that price, they will wait until they can buy it at, say, $45. This difference in the price you'll pay and the stock's worth or the discount you're hoping for is known as a margin of safety. And it is probably the most important tool in an intelligent investor's arsenal, because not only does it make you think twice about each deal, it also gives you greater profits, and most importantly, even if the stock doesn't grow the way you had hoped it would, the simple fact that you bought it for cheaper than it's worth means that you will still make some profit, while people who bought it as is will just end up wasting their time. And while the exact margin differs from business to business and industry to industry, for the most part, you should only buy stocks at 20 to 30% below the intrinsic value to ensure safety and good profits. And now, with all of these things done, you should be able to pick, pass through, and invest in stocks at the same level as trained Wall Street professionals. And sure, you won't see results immediately, but I promise you, by following a few smart tricks and not giving into superstitions, you will make the stock market your playground in no time. And that covers our comprehensive intelligent investing guide. And with that, we must ask you, what do you think is more important in the stock market? Experience or knowledge of things like these? Also, if you found today's video helpful, you may also find our video on another legendary investing book, The Psychology of Money, which you can watch by clicking on the thumbnail on your screen right now. And well, on that note, we must end today's video. I hope you enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care, and I'll see you guys next time.